Hey everyone, welcome back to another episode of AWM Insights. I'm your host, Erik Averill, and I am joined as always by my co-host, older brother, Brandon Averill, certified private wealth advisor and the co-founder of AWM. Brandon, welcome to the show. Exciting times in the market. I mean, this is absolutely wild what we're experiencing. And I also think it's one of the best teachable moments for investors. And the reason I say that is through the close of the market this previous Monday, the 23rd, the S&P 500 was down 34%. And I think the general sentiment around investors was like, is this thing ever going to stop falling? And a lot of emotion was around that. And so I know there were high tensions, people asking, should we take our money out of the markets, and ultimately trying to time it in one situation. But then we see this reverse course. Over the next 3 days, the market would bounce back more than 17%, going on record as the biggest 3-day gain since 1931. And today we're recording this podcast on the last day of the quarter, and the trailing 5-day performance is a positive 7.37%. And so as today, the markets have already reclaimed 50% of the temporary decline. So it has me asking, and I think a lot of other people asking, Brandon, is can we confidently claim that last Monday was the bottom? And does it actually matter if it was or wasn't?
Erik, it's a great question. I'm hearing it a lot as well. And I would say that can we confidently say it's the market bottom? Absolutely not. I don't think there's anyone out there that can reasonably make that assertion. If they are, they're probably kidding themselves. And to the question of ultimately, does it matter? Again, the answer is probably not. Yes, it would matter if we had a predictable way of knowing that was the market bottom. If that was the case, right, we would probably have seen much bigger increases because everybody would be flooding into the market if you had confidence of knowing that. So when we look at all the evidence and kind of take that assumption, knowing, hey, we got no shot to understand whether this is the market bottom or not, we turn to the data. And I thought this was really helpful. This is a good exercise that we work through. But it was really, what's the impact of timing of the market? So let's assume we were the worst market timer of all time, and we decided to invest our money on average at all-time highs. What do those returns look like if we put all of our money into the market at all-time highs? And what we find is, on average, 1 year later, your return would have actually on average been about 13.3%. And then 5 years later, it would have been about 8.7%. So, one good observation there is even at all-time highs, you're still having a positive investment experience. If you were lucky enough to have some model to actually invest on average when the market had declined 20%, we compare that, and your 1 year average return would be about 14.2%. And 5 years would be about 11.8%. So certainly higher, and we would expect that, right, if we're investing when markets have declined. But I think the good observations from this are two: that on average, in both scenarios, we had positive investment returns. And the second thing that is that on average between the two, we're right in line with market averages over time. So at the end of the day, the good news is we don't have to try to figure out when the market bottom is, because it's darn near impossible, if not impossible. And, if we are just invested and we continue to be in the market, we're going to get something close to market averages return. So, we kind of go back here at AWM that, is today a good day to be invested in the market? Generally, the answer is absolutely yes.
Brandon, that's fantastic information. And one of the things that stood out to me was your emphasis on, let's go back to the data. What does the evidence say? And the reason I think that's so important is during crisis times, one of the most dangerous side effects that we see is now everybody's both a medical expert and a financial expert, right? In this coronavirus conversation, all it takes is popping on social media and everybody's offering an opinion, and it's scary. It could be devastating. I know I live here in Arizona, and unfortunately, after President Trump had just made a comment about potentially using malaria type medicine, some people self-diagnosed and sadly ended up killing themselves. And while that might be an extreme when it comes to your financial advice, we're seeing the same thing, right? Is whether it's, hey, Delta can't go down this much, and now's the opportune time to buy the individual equity. Or, we had a surgeon providing advice on whether they should buy Exxon. And so what's happening is you're having all of these amateurs come along and offering advice, when in reality, you should be asking the question of who should I trust when making financial recommendations, and who is credentialed, and, who really has this fiduciary obligation to your family. And so we just highly encourage people to take a step back during this time and make sure that, the people you are taking advice from have the, the credentials and the expertise in doing what's in your best interest. And so, Brandon, one question that we covered on a previous podcast is, what is this value of real expertise that comes from an advisor? Is something that you could share with us of the type of value that that a qualified expert should be providing to you during these times?
Yeah, fantastic question. I laugh at the example of the medical doctor giving financial advice. I think a lot of our listeners here, a lot of our clients, right? You're experts in your fields, and it's almost laughable for the athlete, right? For me to, hey, just because I played a little pro ball, I'm going to jump in there and hit DeGrom's slider, right? That's kind of funny. Or if I'm going to hop in there and perform a hip surgery, it's equally kind of laughable. But for some reason, everybody becomes a financial expert during these times. And I guess it makes sense. We're looking for confirmation from people that we trust. But really, when we turn and look where the value comes from taking the data again, right? And using a systematic approach to make financial decisions. And so one thing that we've turned to, and we've referenced previously on this podcast, is opportunistic rebalancing, and really having a systematic approach. So sharing with you guys, this happened to us over the last week. So last Friday and Monday, we actually had our tolerance bands and our models hit. And thankfully, we've implemented a systematic way of taking advantage of that information. When our target allocations move, in most cases, 20% off of their target allocations, then we go through a systematic approach of bringing those accounts and allocations back in line with what our targets are. I'm not going to stand here and say that we were so good to have called what at least appears to be the bottom for the short term period on Friday and Monday to implement these. I mean, that was definitely luck. We'll be the first to admit that. But sometimes it's better to be lucky than good. And we were very fortunate to have the systematic approach in place. So basically, if you take a 60-40, 40% fixed income or bonds and 60% equity, what had happened is our equity allocations had declined with the rest of the market. And they hit that 20% tolerance band. So we were able to then go into action and go ahead and sell some of that fixed income, some of those bonds that had increased in value, and bought some of the stocks that had declined in value. And fundamentally, what ended up happening is we were able to buy those stocks on Friday and Monday when the markets appear to, at least for the time being, hit that bottom. So a really good example of having that process in place, and the market went on to take off. So now we're sitting in a pretty good position for the wealth creation for clients in our accounts.
Brandon, thanks for sharing that. And I know it's hard to quantify those type of things, but Vanguard had done a study previously that intelligent rebalancing adds about 0.5% of annualized return to a portfolio. So, which is meaningful over the long term. And so, really appreciate appreciate you sharing that. And so, listeners, we appreciate your guys' attention. We know that these are tumultuous times, but we encourage you to control what you can control, stay focused, stick to the long-term plan, and we will join you guys on another episode of AWM Insights next week.